$24,000 in potential tax advantage contributions, gone. And the CPA wasn't the problem. I've spent 28 years working with business owners at the 600,000 to multi-million revenue level. Most had solid CPAs. They were smart, they were responsive, they were reputable. And the business owners were smart business owners. They were doing everything right and still overpaying taxes. And here's what I found. It wasn't a tax problem, it was a coordination problem. And until that's fixed, everything else stays broken. In this video, I'll show you exactly what that looks like and how to fix it. What do I mean by coordination? You probably have good people on your team, a CPA, a financial advisor, a bookkeeper, an attorney, but nobody is responsible for making sure the whole plan works together during the tax year. And here's what that looks like in real life. Most business owners assume that having a good CPA means they have a tax strategy. And to be clear, most CPAs are excellent at what they're hired to do, compliance. They make sure the tax return is accurate, it's defensible, and it's filed correctly. But compliance is naturally backward looking. It reports what's already happened. Real tax strategy is forward looking. It's decisions you make during the year, like how you pay yourself, what retirement plan you use, timing of the income and your expenses, and making sure your books actually support the strategies. When nobody is coordinating those moving parts before December 31st, you find out when it's too late to make any adjustments. I had a client. I recommended fund a Roth IRA for the year. She told me her CPA said she couldn't because she didn't have earned income. So we got on a call. Me, her, and the CPA, and we walked through the full picture. Turns out she could actually contribute to a Roth IRA. My client was shocked because she had missed 3 years of Roth contributions simply because the question was never pushed further. That's $24,000 of tax advantage contributions that did not get used. And you don't get those years back. Once those contribution windows close, they're gone. And the bigger point is, if something this simple can get missed without coordination, imagine what happens with bigger decisions like owner pay, retirement plan designs, and timing. And this isn't a one-time mistake. Every year without coordination is another year of windows closing and you potentially overpaying in taxes. So this isn't about blaming your CPA, it's about understanding the gap. Your tax return is the report of what happened. That's compliance. But if you want to reduce taxes, you need coordination during the year while you can still change outcomes. And in the first place, most high earners feel this coordination gap is in estimated taxes. Because if nobody is telling you what to set aside as you go, you'll spend it. And then that payment feels like an ambush. A lot of business owners don't have a clean system for quarterly taxes. Sometimes payments get missed. Sometimes they're uneven. And a lot of people end up extending just to buy time. And I see this all the time, even with business owners doing 600,000 to $1 million plus in revenue. Most business owners don't realize this is costing them thousands a year. Handling your quarterly taxes like this can create penalties. But the bigger issue is simpler. All year long, you've been spending money that was never yours in the first place. I remember when I first started, I was 24. My March and my April commissions were basically my tax plan for the year. I'd work as hard as I could those 2 months, hope I made enough to live and cover the tax bill for the full year. I was constantly stressed, and I remember thinking, there's got to be a better way to do this. And here's the shift I had to make. That wasn't my money, and it's not yours. When revenue comes into your business, a portion already belongs to the IRS. If you don't separate it, you will always feel behind, even in a great year. Now, what I personally do is simple. I sweep 20% of the revenue into a separate tax account automatically. I don't touch it, and I pay estimated taxes out of that account each quarter. Now, 20% might be right for you or completely wrong. That's where coordination matters. Someone who knows your income, your state, your entity structure, and how you pay yourself can get you the right number, so you're not guessing. Because once you do this, you finally get clarity on what's actually yours to spend. There's a big difference between profit on your P&L, cash sitting in your account, and what you keep. And the next coordination issue is the one that creates the most conflicting advice: your salary. The next place the coordination gap shows up is your salary. Your CPA is usually trying to keep payroll as low as reasonably possible because W-2 wages create payroll tax. Your advisor often wants your W-2 higher because higher wages can increase how much you're able to put into certain retirement plans. And to be clear, both are trying to help. They're just optimizing for a different outcome. And if nobody coordinates it, you end up with a number that's fine, but not actually optimal. So let's make this real. If you pay yourself $120,000 in W-2 wages and take the rest as distributions, you may reduce payroll taxes, but you can also limit how much you're able to fund into retirement plans. If you increase your W-2 to $220,000, you may unlock more aggressive retirement funding, and that can reduce your taxable income. But here's the trade-off. Payroll tax generally increases when W-2 increases. So you're balancing retirement contribution room and income tax savings against payroll tax costs of that higher salary. And that's before you layer in things like QBI phase outs, the type of retirement plan you're using, other deductions, and your overall income level. It gets complex pretty fast. So this isn't about right or wrong, it's about the coordination. Because your W-2 salary, your retirement contributions, your deductions, and your phase outs all affect each other. Without that coordination, you're not optimizing, you're guessing. And guessing at this level gets pretty expensive. And this level of coordination can't be accomplished with a quick tax season meeting after the tax year closed, when most CPAs simply don't have the time to run through this level of planning for every client, nor are they set up to do so. Which leads to the next problem. The tax return turns into an autopsy. You're looking backwards, trying to find savings after it's already too late. Everything we just talked about leads to this moment, and every year the same pattern keeps repeating itself. You get your tax return, you review it, and you feel that familiar frustration. I wish I would have done something different. And you probably said the same thing the year prior. Your CPA may throw out a few last-minute ideas, but at this point, most of the meaningful levers are gone. The year is closed, the decisions were already made. So you take whatever small wins are left, you sign the return, and you move on. And this is the part no one talks about. A lot of business owners sign the returns without really understanding what drove the outcome or what they're supposed to do differently this year. Take QBI as an example. Whether you qualify and how much you get is often driven by decisions that have to happen during the year. How you pay yourself, how income is timed, how business is structured, how the books are categorized. By the time you're reviewing the return, the result is already locked in. That return is just showing you the outcome of the decisions that were made or weren't made months ago. So yes, a tax return is an autopsy. It shows you what happened. It doesn't change what happened. The real strategy session should happen right after the return is finalized, when the numbers are fresh, and then you use it to plan the current tax year. For my clients, that's exactly what we do. We take the returns, run it through a process, link it to the broader financial plan, and identify what needs to change now while there's still time to actually change the outcome. What coordination actually looks like is pretty simple. Mid-year planning, updated projections, a clear owner pay strategy, and knowing your numbers before December, not after. That's the role I play. I'm a business owner. I'm a certified financial planner. Our planning is built around quarterly sprints focused on 3 core pillars, and they're actually what define our company name, TriBox. We help clients think through cash flow. We help them protect and grow what they've built. And when those 2 foundations are in place, they can approach investment decisions from a position of clarity rather than pressure. Cash, protection, and investments. We're not CPAs, we're not attorneys, but we make sure those relationships are coordinated so the tax plan, the legal structure, and the financial plan are all working from the same picture. That's the role I play. If this was helpful and you want to go deeper on tax strategies that could potentially save you millions over time, watch this video next. And if this sparked questions and you want to connect about them, reach out using the link below to set up a 20-minute chat. I'm here to help, whether it makes sense for us to talk further or work together or not. I enjoy these conversations and I appreciate you watching. I'm John Rojas and I'll see you on the next one.